Welcome, everyone, for our Westcliff Thrive in 25 series. We're going to start today with the Biosis Real Estate Development, where Addie and I are very pleased to have Samuel Herschorn here from Biosis Real Estate Development. We'll look forward to a really robust discussion on some of the exciting developments they have on the go.
Thank you for having me.
Thanks for joining us today. So we'll do a bit of an introduction on Westcliff and what we do, and then we'll dive right in to learn more about Samuel and what the Biosis team is up to. So as far as the Westcliff team, I'm joined by my partner and colleague here, Adi Saeed. He's a well-established realtor, over 20 years experience. He's a registered dealing rep. And then myself, a CPA, CIA, I've worked a long time in real estate finance and accounting. I also am a registered dealing rep. And so we work hand in hand in the Westcliff team. And we'll talk in the next slide a bit more about what Westcliff does. So our ethos at Westcliff is really three things. We focus on helping our clients learn, invest, and manage their real estate. As far as learning, we've got a number of webinars such as this, our weekly podcast, and there's opportunities there to learn more about how you can really learn and get involved in real estate, whether that's an active or a passive role. On the invest side of things, again, we have opportunities where we work with some of the vetted sponsors that we've worked with, or even deals of our own, and even through the Waverly relationship that we have for ways that you can invest in real estate. Again, you can learn more about that on our website. And then, of course, on the managed side of things, we also offer ongoing asset management services. So if you have an active deal and you're looking to have someone property manage it for you, do your ongoing accounting, taxes, that sort of thing, you can reach out. For more information on all of this, you can book with us at cal.westcliffam.com or just our website, www.westcliffam.com. So with that, let's dive into the investor presentation, and we'll start with getting to know Samuel a little bit. Samuel, you've got a pretty unique background being an architect, so I'd love to hear more about what got you into real estate development. And then in the next slide, we'll probably talk a bit more about how your team kind of came together, because it is a pretty unique set of individuals that have come together to form Biosis Real Estate.
Yeah, so I got into architecture kind of on a whim. I had some artistic talent and I wasn't really sure what I wanted to do coming out of high school. I considered maybe going into law, getting a law degree, but that just seemed a little bit uncreative to me. Like I wouldn't be able to exercise my creative skill sets. So a teacher suggested I apply to the Carleton, the Israeli School of Architecture and Urbanism up in Ottawa. It was a very rigorous program, very difficult to get into, and I managed to get in. I think they only accept 80 out of 1,500 applicants. So I said, okay, I'll give it a shot. And it stuck. I ended up taking it right the way through my undergrad and got a master's degree in architectural design. I got into the workforce and found I was working, 60 hours a week, often unpaid overtime. Their excuse was, oh, we're training you, so you need to give value back to us. And I was looking ahead at some of the more senior people in the architecture firm I was working for, and they were still working 60, 80 hours a week, and they weren't getting paid much more than I was, and I was barely earning more than minimum wage. But we were still working with these massive developer clients, guys who seem to have a lot of money, seem to have their finances figured out. And I just asked the question, okay, first of all, is this something I really want to continue doing? It's not going to give me the mode of life that I'm looking for. And then the question number two, what else could I be doing? So it was around that point I picked up the little purple book, Rich Dad, Poor Dad. And that book kind of flipped the light switch in my mind. And the premise of the book is that you start a business, you invest the cash flow into real estate, and you get exponential growth. And I took that one step further and thought, well, hold on here. I design and build real estate for a living. What would happen if I created a company that could then invest in real estate development and from there manage the assets so that I could take advantage of both cash flow and appreciation? And that led me to start my journey as a developer. I met Michael Davidson through a mutual friend and Michael, he's a very interesting character. He's very driven. He's a triathlete. He's done many, many marathons. He's a self-published author. And he was starting to build his own real estate developments. So we got together, started working with a coach, and before long, Michael brought Graham, our other partner, into the fold. So Graham is a civil engineer. He has his own civil engineering company. And he has a business degree and his PMP, his project management license. I brought Dakota into our group. So Dakota I went to architectural school with. He ended up going the architectural technology route. So his focus is more on building systems and technologies, building automations, and 3D modeling. So he heads up our project management and plan and development planning. Graham, his engineering background, he's very good with numbers, very skilled when it comes to Excel spreadsheets. So he actually developed our pro forma model and he heads up our underwriting division. Michael, he's in technology sales, so he's very skilled at picking up the phone, calling people, and looking after our investor relations division. And then myself, as the architect, I'm kind of overseeing business development and operations. So that's how we come together as the Biosis Real Estate Group, and we have a very unique team, over 50 plus years combined experience designing and building real estate for other developers, and now we're doing it for ourselves.
When you bring those internal capabilities together, does that result in less work being outsourced to third parties, typically in development? Like, how does that all come together for you guys?
Absolutely. So we have a sister company, Biosis Designs, which is my architecture firm. And the way it works is the development company finds the deals, puts the land together, raises the capital, and then the architecture firm will design it, lead it through construction, and then hand over the keys. The advantage there is we work hand in hand, the architecture design side and the development side, to create these upfront schematic designs based on the zoning bylaw, the building codes. So we really do a much more in-depth higher and best use analysis. So for example, let's say a 2-acre parcel comes across our desk, and usually you see the listing agents and the info. Well, we then do a deep dive into the zoning bylaw. We then reconstruct the site in 3 dimensions. We create our concept with multiple space plannings. Where's our parking? How many units? Where's the amenity space going? All the different building systems that also get incorporated into that. And then we take the actual square footages from that model and plug it into our pro forma, listing all of our costs, all of the planning requirements, and it spits out what we think is a much more realistic and more accurate depiction of the profit value for the project. And we're able to do that at no additional cost to us. So, we do have a quick kill checklist that we go through to say, does this fit our model and our niche? What's the market like? Are there any red flags? What are the quick budget numbers? Does it make sense? And then we go into that deep dive. So there is a bit of upfront investment on our parts that we put in, but the yield is that we are much more confident moving forward on a project because we've already done the upfront due diligence that most developers are paying thousands of dollars to sub-consultants to do for them.
Can you tell a little bit more about what your core competency is? Like, what's the investment thesis? What is the type of asset that you guys focus on mostly?
Yeah.
Like, what's the box that you have drawn?
When we got started, this was the height of the bubble, 2021, 22, 23. We were underwriting hundreds of projects. And it took us some time to kind of refine what we felt worked best in the market. We looked at some of the smaller deals like duplex, triplex, fourplex, but those were just too small to make the numbers work, at least on a scale that we found attractive. But then you go to the opposite end of the spectrum where you're doing high-rise, 200, 300 unit buildings, the ones that like the Greystones and the Great Gulf developers are focused on. And we just found that there's too much upfront capital required. Concrete construction and high-rise construction triggers different regulations in the code. There are logistical implications as well. So it's just very difficult to make those work. And we didn't want to start messing around with the big players out there. So we ended up focusing on are these low to mid-rise, mainly wood frame or light gauge steel frame apartment buildings in high growth areas in secondary markets. So we have been looking in Toronto and Ottawa, but we've also been looking just outside those cities in the GTA and in the Ottawa suburbs because there's a ton of opportunity there. As these larger cities became full and their vacancy rates plummeted to below 2%, people started moving outside of the cities thinking, you know what, I can commute into work. And then when the pandemic happened, it was like, oh, I'll just work from home. So a lot of these smaller towns started to just explode in population, but they don't have any housing. There aren't really many developers looking to build out there. So they're desperate for new housing to be brought to those areas, and that's kind of where we shine. So we're doing these apartment buildings and some stacked townhouse communities in these areas, and the numbers are looking really good. Not only are we able to get these approvals passed a lot faster than, say, a larger development, but we're also able to stick in a cost per square foot range that is a lot more affordable, but still take advantage of those higher rents that are being pushed up by this high demand.
So basically, what you're defining it as a wood frame, high growth, secondary market, and then you're also looking at building mostly rental, or are you doing for sale as well?
We're strictly focused on rental right now. The for sale market is going through some changes and some challenges, but we started doing rental pretty much from the get-go, taking advantage of CMHC financing, taking advantage of all the incentives that the municipal governments and provincial governments are giving to rental development. And so that's kind of what our focus has been on.
So you have talked about two companies, Biosis Development, Biosis Design. What's the execution look like? Have you guys completed any projects already, or are there anything underway?
Yeah, we started small, so we've done a few triplexes and a sixplex. Now we're testing out some of our thesis around construction and modular construction specifically. And now we're growing to larger builds. We've got a 52 unit stacked townhouse community that we're developing. It's about half hour outside of Ottawa. We've got a 70 unit apartment building in Ottawa that we're putting together. We've got we're pursuing a 50 unit in Kingston right now in partnership with another group there, and a 60 unit apartment in the Toronto area. So our philosophy has always been the more people you can work with, the more great things you can do. So on those apartment projects, we're partnering with other landowners and other developers to help bring them to life.
So you have Biosis Design, Biosis Development, and you're also getting into partnership with other landowners and builders. It's a unique value proposition that makes Biosis different than other boutique developers in the area.
Yeah, so we're not bankers, we're not your CPAs who say, wow, there's an opportunity in development. I'm going to just go out and hire whoever I can and try and get it done. We're the people they come to when they want to do development. We're the ones who, are designing and building these things. And we do take on outside clients as well. I have a number of architecture clients, and Graham has clients on the civil side. But we bring that wealth of experience to our own development deals. And it also allows us to streamline that process. You're not losing time going back and forth between the consultant and the client. We're not overthinking decisions because we already know ahead of time how we want to design and build these projects. It becomes more how do we find the sites that fit the mold as opposed to how do we mold the site to fit our needs, which means that we're able to push out these approval packages a lot faster. We work closely with the cities and municipalities to get them passed, but we already know what they're looking for, so it gets through very efficiently. And then we have a host of contractors, subcontractors, other consultants that we've been working with for a long time that we like and we know and we trust. These relationships that we've built up in all of Ontario that come into play on our projects and make them much more likely to be successful.
So we have a couple of projects of yours on the screen right now. Do you want to just give us a quick rundown as to what stage they're in right now?
Sure. This nicely shows our progression. So starting with the far right, that's a triplex project that we completed in the Britannia Beach area in Ottawa. This was a project where we first implemented a modular system. So working with a company called P3 Panel, they built all the walls, the floors, the roofs in a shop, and then they shipped it to site and erected the building. It was two guys in a lift truck who were putting it together. One of our core thesis is that construction and the availability of labor is getting constrained. We have not been investing in the skilled trades. We have not been bringing in enough immigration to fill the needs going forward. And we experienced this in 2021 and 2022, where there just wasn't enough active labor to support all the construction at the time, which was pushing up costs. We expect that trend to continue. So the solution is to do a modular system where it's built in a factory and shipped to site, so you don't have to deal with all that labor and all the site components that go into it. So this project, the triplex, this is where we first tested that technology out. I can tell you that there are savings to be had, but at this scale, it didn't quite make sense. We ended up building that one for about $300 a square foot. And there were hiccups on site that we learned from that we're now applying to our current projects. One of the key ones being that the foundations, you really have to make sure that your site surveyor is surveying the formwork properly ahead of time. We ended up finding that one of the walls that we poured was 6 inches out from where it should have been, and that meant the prefab panel didn't align properly. Luckily, we were able to make some adaptations on site to make it work, but that was just one of the lessons that we learned from doing that project. The next one, the Maitland expansion, that was an existing house, a single-family home that we expanded into a 5-unit apartment. Maryvale Apartments, that's a project we worked on with a client, developing a 6-story, 20-unit apartment on a very narrow lot. It's kind of a landmark project for the area as the whole area got upzoned to permit these larger mid-rise apartments, and this will be the first of its kind. On a 50 by 115 foot lot, it's a pretty remarkable project. A lot of little details that went into this to make it work on such a narrow site. And then the last one there, that's our 70-unit apartment project. That's also in Ottawa off St. Laurent Boulevard. That one we're going to be doing entirely out of modular ship-to-site units. So a factory is going to build these units in whole, completely finished, fitted out, and then it just gets stacked on site. So that takes the build time so they can produce about 2 modules per day, and they can install about 1 floor per week. So 6 floors, it's going to be a 6-week project to install, as opposed to a 12-month project. So you can see that the site time gets cut down quite significantly. So yeah, those are the ones we have on the go.
Can you talk a little bit more about this?
Yeah, so the manufacturing facility can manufacture 2 units per day.
Like the actual full unit, or like
That's right.
Wow.
The full unit. And the way we've done it is we've designed these units to be shipped to, you can put them on the back of a flatbed pickup truck, and they get just driven out to site, and then there's a crane on site, picks it up, they position it with cables and drop it into place. And it's almost like building with Lego blocks. So not only do we have a mix of studio, 1-bedroom and 2-bedroom units, we've also designed these circulation modules. So all of our elevators, stairs, our lobby, it's all these aspects of the building can literally be built in a factory and shipped to site. So it's not a brand new technology, but this is where the future of construction is really going. You have just such a higher degree of control in a shop setting on the quality, on the output. And what's really interesting is all of these units are CSA approved. That means you don't need a building inspector to come out to site until you're ready for occupancy. So there will be a foundation inspection, and then there will be an occupancy inspection and potentially a roof inspection as well. But that's it. So when you're a builder on site, usually your framing goes up, okay, I need a framing inspection. Your insulation and vapor barrier goes in, I need another inspection. Your drywall goes in, I need that inspection. Each inspection, you're usually taking about a week between the time you're able to get a hold of the inspector, schedule it, get them on site, and then have the inspection done. And then there might be some revisions and rework that has to be done as a result. We cut all of that out, not required at all. It's basically like these units, it's like you're shipping a washer dryer to a site. You don't have someone going in and opening up the units, the washer dryer, and looking at all the inner workings. It's already stamped. It's CSA approved. It's good to go. That's the revolution that this is bringing to the construction industry, and something that we're heavily bullish on.
As you've rightfully pointed out, there's been a lot of projects and a lot of companies and a lot of money has been thrown towards this modular development, modular building processes. What were some of the challenges that have caused it to not really be adapted by the industry? In your opinion, what were the big challenges that caused it not to be adapted, and what is it that you're doing that is so different and you think that it is going to become like an industry standard?
Yeah, so there's a couple things that have kind of prevented it from exploding until now. The first is familiarity, right? People only in an industry where there's high risk, high reward. You want to try and mitigate as much risk as you possibly can while maximizing your returns. And when you're doing the same thing every single time, you become very familiar with the process, and that seems less of a risk. So you're going to keep doing things the same way because you already know what all the risks are, you know how to mitigate them. To change something, to do something different, that adds a level of unknown and uncertainty that most developers they just don't want to get into. So there was that barrier. The next barrier has been around figuring out the scalability and the demand for this sort of a solution. It's quite a significant investment to create a factory that can build modular units. You're talking multiple millions of dollars just to get started. So you do have companies like Ellis Don and some of the other larger developers who did invest in this, but at the same time, there wasn't a huge demand for it. So they had to shut it down. And now you're seeing them ramp that up again because now is the right time to start building these companies. And then the next challenge has always been around the financing. Banks don't know how to finance this structure because it's not a conventional draw system. So conventional construction, you have your monthly construction draws. The contractor orders the parts, gets delivered to site, and then they install it, and then they bill that level of completion at the end of the month. The bank gets a certificate from the architect, they send their quantity surveyor, okay, there it is, it's the material, okay, we can sign off, here's your check. You don't do that with a modular construction because it's all done in a factory. And the factory setting, they pre-order all of their materials at once and then start, producing these things. So the banks, they're just like, this isn't what we're used to. We're not going to finance it. So that was a big hurdle leading up until recently. There weren't very many lenders who were willing to step outside of their comfort zone and lend to these projects. So most of these projects would be self-funded and self-financed by larger developers who, wanted to test this technology out. And those are few and far between. We're seeing that all changing, especially with Mark Carney's government pledging $25 billion towards this technology. I expect the vast majority of that investment will go towards funding banks who will then fund these projects and restructure their systems. And another reason why that's so critical is instead of doing your material orders in segments, I mentioned it comes all at once. So working with a modular development or manufacturing firm, there's a series of deposits, a first deposit for design, a second deposit for getting to permits, and then you have to basically put 50% down to purchase all the material at once. And that's a huge chunk of money that comes before you've even broken ground. So again, it doesn't follow that standard formula for banks where they kind of parse this out over the course of the project.
Yeah, no, Peter Gilligan from Anatomy just recently announced that he's making a huge investment into modular homes.
Hmm.
And one of the questions that always comes up, is it going to be successful? Like as you pointed out a couple of companies, I know a couple of companies, and I'm actually getting inquiries from investors that are looking to open up these factories. I have one developer who builds hotels, and they're
Hmm.
actually looking at spaces where they can pre-make their hotel rooms so that it can be shipped on site and just put together as Legos. Thank you for taking the time and explaining that. Let's jump into your Kemptville project. Can you talk a little bit more about this project that you have and what attracted you to Kemptville site specifically?
Yeah, so this site came across our desk because my partner Michael has a family member who is a realtor in Kemptville. She wanted to move away from residential, go into commercial, and she found this property. This is basically central Kemptville off their main arterial road. It's a 2-acre site previously used for commercial self-storage, but it's in the middle of a residential neighborhood. So the municipality, North Grenville, they're headquartered in Kemptville. They've been wanting this site developed for years because it doesn't fit with their zoning. Like, it's zoned residential, but it has a commercial use. The previous owners, they were custom home builders, and they didn't want to get into rental developments, and they were having some cash flow issues because at the time nobody wanted to buy new construction. So they were looking to offload the site, and we negotiated an amazing deal, 2 acres. We bought it for $930,000, which is about $10 a square foot. That's basically the price of a home in Toronto, buying a 2-acre site. And we're going to be building 52 units on it. So there's a massive amount of value add through that exercise. And in terms of a location, like, you really can't beat it. We've got a large commercial district just down the road to the west, shopping and groceries, and there's a Shoppers Drug Mart. Across the County Road 43, you've got City Hall, you've got a large community center, you've got a vet clinic, and then if you head out east, there's the 416, which is just less than a kilometer away. So if you were living in Kemptville, wanted to commute to Ottawa, it's just a 30-minute drive. You just quick hop, skip, and a jump on the 416, and you get to Ottawa. And then on the other side of the 416 is a large employment district, a Walmart, Canadian Tire. You have a large insurance company and brokerage that works out there, and it's expanding. There's about 4 or 5 acres of new commercial that is going to be built at that site in the next few years. So in Kemptville itself is just exploding in population. Since the pandemic kind of shut everything down, people moved out to Kemptville looking for a bit more space, a nice quiet town where they could start a family and start to grow and live a more comfortable lifestyle. But it meant, like, there's now no housing available, and certainly no rental housing. In fact, the vacancy rate is almost 0%. If you were to go on like Zillow right now and look up places to rent, you might find 4 or 5 properties that are available. And they're usually like single family homes that you'll rent for $3,400 a month. There's no 1 bedrooms or 2 bedrooms available. They just don't exist. So when we were doing our due diligence on the site, we met with the mayor, we met with planning staff, and they were thrilled. They said, yes, please build us rentals. We desperately need it. Originally, our plan was to have like a private road that spanned through the middle of the site and then have 4 blocks of 12 units each. But then as we started to go through the site plan process, the town said, hey, we've got a strip of land to the south of your site, directly adjacent. Why don't you build us a municipal road there instead? So we were able to recoup about 13,000 square feet of space on the site. We added extra parking, we added these large backyards, more green space, and what I'm most excited about is this is a playground right in the middle. So now we've got 2 large blocks of units, 26 units each, and in the middle we've got a playground structure where young families are going to be able to take their kids and actually enjoy the outdoors in their rental community. So we've increased the unit count, we've increased the appeal, and we're going to do some cost sharing with the city on the municipal road that we'll donate to them, and then they'll handle all the maintenance and the snow plowing.
So by the sounds of it, it wasn't zoned. So it was zoned for custom homes. You guys bought this 2-acre land. You went in and your initial projections were 48 doors. And with some clever maneuvering and talking with the city and going into partnership with the city and having a win-win mentality, you were able to increase the units to 52. Also provide bigger backyards, so make the product more appealing to your tenants, and was able to project out a better return. Can you talk a little bit about what's the tenant demographic that you look to attract with this development? First of all, these are mostly townhouses, so 52 townhouses, 4 blocks or 2 blocks now?
So it's
Blocks of
2
property.
blocks.
Yeah.
So there's 26 2+ den and 3-bedroom townhouses, and each one comes with a 1-bedroom accessory dwelling unit. So it's 56 units total. However, the nice thing is that the bylaw only considers the 26 townhouse units as being eligible for development charges. We don't pay development charges on the accessory units. So there was a substantial savings on that regard. And then the introduction of Bill 117, we're able to defer those development charges until occupancy. So there's a big chunk of upfront cash we didn't need to bring to the project that was in our original budget. So there's additional savings that way.
So tenant demographic, who are you looking to attract here?
Yeah. We're looking at young families, young kids who are working professionals who are moving into Kemptville. They want a more spacious unit, but they're not quite ready to dive into home ownership yet. They will probably have a car, and we've got plenty of parking, but there's also a work from home aspect that we've included in our designs for. And they typically have higher than median incomes when it comes to Ontario as a whole. Kemptville has a lot of wealthy people or high earners, I'd say, who are living there. In fact, the median income is about, I think it's 108,000 versus the 90,000 for all of Ontario, so it's higher than the provincial averages. And they're really that young family, they're looking to grow, and Kemptville is a great place for that. Lots of soccer fields, there's lots of activities. They've got a park where they host concerts in the summertime. There's a lot to like about Kemptville if you're a young growing family.
Any questions?
So on this slide, we summarize some of the housing demand and some of the characteristics. Because most people who are listening to this webinar probably aren't familiar with Kemptville. They're familiar with Ottawa. Talk through a little bit on what you think about the demographics and the demand and some of that element of the project.
Yeah, so Kemptville is going through quite a glow up. Their population has been growing by about 9% every 5 years. I think it's just under 2% a year. With that expected to accelerate and continue to grow. By 2026, it will have grown by 16% compared to 2021 levels. And the municipality has really been actively trying to accommodate for this growth. So they've put in about $22 million of an investment into expanding their wastewater treatment infrastructure and doubling that capacity. And this is to accommodate the growth because people want to live in Kemptville. The crime rate here in Kemptville is far lower than the national average. Employment is higher. The median income is a lot higher than the national average. And it's mainly because when people are tired of living in Ottawa, living in the city, and they want to move out to the burbs, this is where they go. They're expanding quite rapidly, and they need that housing to keep up with it. Rental rates are pretty much on par with Ottawa. The cost of housing has been pushed up as well. There is an affordability issue which the municipality is trying to address, and that we're trying to address as well with our development.
I think it's exciting to see that the city or the town here is investing in the utilities, the water, like the access to that. That's one of the most challenging things when developers trying to move forward on a site is trying to get those allocations, as we call it. Have you seen a positive impact here on this site versus things you may have investigated in other sites?
Yeah, definitely. So the expansion of their plant is kind of a double-edged sword. It means that they're growing rapidly, but it also means that development can't really start until you've been allocated your services. Thankfully, we squeaked in under the wire. We got all of our services allocated to us early on. We've been given that green light to move ahead, and that's what we're doing.
So let's talk a little bit about timelines and strategy. Like, where do you sit today and what is the project looking like going forward?
Yeah, so right now we're in full swing capital raise mode. We've closed our first 2 rounds. We're in the third and final round to raise for construction. And we're projecting to kick off and break ground in the fall. We've budgeted about 16 months to build. That includes all of our site works and then bringing in and going vertical. And then we've budgeted about 8 months from the point of occupancy to get the building completely leased up. And then we'll be managing the property from there. Expecting about 4-year hold before we would sell this project to an institutional buyer or a private investor.
What do you see as one of the biggest risks in meeting these timelines?
The biggest risks right now, it's kind of hard to say because we've been moving ahead pretty steadily. Closing on our investment capital is what we're focused on right now. But we have our town council hearing in a couple of days to get our rezoning approved. We've got the full backing of municipal planning staff for that one. Site plan approval has been going ahead congruently, and there haven't been any big changes required there. Going from a conditional site plan approved to full site plan approval will take time as the lawyers need to draft it up, but during that time, we've been working on our permit applications and construction drawings, and we're on target to break ground in the fall. No hiccups as of yet.
Excellent. I think on the next slide, we talk a bit through the numbers a little bit. Your favorite topic, metrics and IRR and all that good stuff. Obviously, the slides will be available to our listeners, but talk through at a high level returns may look like for your investors and even for you guys as sponsors.
Yeah, so project level, we're breaking 30% annualized rate of returns. When it comes to what investors can expect, we've got two share classes. So our Class A comes with an additional 10% bonus preferred return. So their returns are going to be a little higher, close to that 30%. Our Class B, which is our common shares, that one, it's a little lower at just under 25% annual rate of return. And what that means is that you're almost tripling your investment money based on when you first invest to when we sell the project.
You mentioned when you sell the project, is there any opportunity for investors to exit before, or is it any tranches available for them to exit, or anybody coming in has to remain in there until the exit?
So everyone has to remain in the project until the exit. That said, once the building is fully leased up, we will be doing a cash out refi through CMHC, and investors will get all of their money back, and plus some. We're anticipating some profit on top of that as well. So that's expected within a 2-year time frame. So really, investors are just in the project for 2 years, get all their money back, and they can reinvest that somewhere else. Meanwhile, they're collecting their quarterly returns and they're earning 70% of the income. They're getting to keep 30% will go to myself and my team.
Talk a bit about the cap rate assumption there. I think it's 4.75. Like, how did we arrive at that?
Yeah, that's based on the standard market cap rates for the area. So I think Ottawa is at 4.25% for a while. That may have expanded a bit, but we're projecting a 4.75% cap rate going in, and we're keeping it the same coming out.
The next slide, I think, is a fun one because it talks through some scenario analysis that you guys have provided. If things don't go according to plan, we hope things go according to plan, of course, and that's how we process going forward. But you've kind of got two scenarios there. One being the construction time just takes longer, or your construction costs go higher than you're expecting. So talk through a little bit there, why you picked those scenarios and how that could impact investor returns.
That's right. So we always stress test our projects. So we've got actually 3 scenarios here. One is if rental rates decrease, and in some markets we are seeing rental rates go down. So if we were to decrease the rates by about 10% to $2.50 a square foot, we're going to see our investor returns go down, but it's for such a dramatic decrease in the rates that we're still turning a profit. So there's some good cushion there. Construction timeline increasing is a very real potential challenge. Oftentimes we see that in sites that the contractor might not be on the ball or might run into some cash flow issues. So we looked at that. If we had to increase the timeline from, I think it was 16 months to 24 months, what does that look like? And you can see we're still above 20% IRR. And then what if construction costs increase, which is another possibility. We've been seeing this trade war kind of explode across the globe. We haven't seen a huge impact on construction costs yet, but in the case that we do, we've run that scenario as well.
And it's important to note, I think, because this is new development and Residential Tenancies Act doesn't apply to these properties. So you're not going to be constrained by rent control and a lot of vacancy decontrol that these guys have been talking about. Your mark to market is going to be pretty quick to be established.
Yeah. And it's a great point. And another point I'd like to make is there is also a flip side scenario. what if things go well? I'll take the construction costs, for example. I think we underwrote this to be around 250, 260 bucks a square foot. We are engaging with contractors right now who say we'll be building closer to between 200 to 220 a square foot. So if you look at next to the construction cost increase there, when there's a decrease in cost to about 230 bucks a square foot, the returns are actually going well up above what we're already projecting. And that we're seeing as being a very realistic scenario as well. Now, we don't want to make any promises. There's still a long time between when we start and when we finish, but it's good to know that both sides of the coin are scenarios that we're planning for.
Great. I think the next slide summarizes a lot of the metrics of the project. Anything you want to highlight here?
Yeah, so in terms of project cost versus value on completion, there's a healthy spread. We're almost at $3 million in terms of built-in equity. And that's after essentially taking out investor returns and interests and all that, or sorry, before. The total operating income, we're looking at about 1.1 million. And we've underwritten this where our expense ratio is pushing just a little under 30%. So it's a healthy expense budget. Could probably get the expenses down. We're also underwriting this to a DCR, debt coverage ratio of 1.2. But we are going for MLI Select, which could get us as much leverage as 95% loan to value. And the minimum DCR there is 1.1. So we're already underwriting above that to be on the conservative side. Yeah, those would be the main highlights, I think. And we've also got a healthy cash on cash at 11%.
Great. Let's dive into the capital stack here. You went a little bit, it's a little bit unique here. So talk to us a little bit how you designed your capital stack and how much does the sponsor equity play into the total?
Can you tell our listeners what does a capital stack mean and why is it very important for investors?
Certainly. So a capital stack is basically how the returns are divided up and how we calculate the payouts to investors as money starts coming in. So we've divided this into basically two tranches. We've got our Class A tranche and our Class B tranche, as well as our sponsor equity. So we put in about $300,000 of our own money to get the project off the ground, get through design and approvals. We're going to be raising a total of $3.2 million. So Class A shares, that's our tranche number one. Those are the early investors into the project, and they get that extra 10% return that I mentioned. And then Class B shares, those are your common shares, and they participate on a 70% of the profit basis, whereas we, as the general partners, keep 30%. So the investor equity is going to the rezoning, closing on the property, getting through site plan approvals, building permits, and that first construction draw. And then the remaining of the funds required is going to come through CMH's financing and a lender.
Perfect. Anything, Addy, from you on this slide?
This just summarizes the various funding rounds. So we've actually closed out round number 2 as well. We're now raising for round number 3 to get us into construction. And then a great note is that we have our own MFT, so we are able to accept registered retirement plans and TFSA funds to invest in this project as well.
What are some of the lessons learned in the capital raising process and working through that? I'm just kind of curious. We've been on a bit of a journey together as you've worked through this. I'm kind of curious how you've been finding it.
We started raising capital and things seem to be going really well. Lots of investor engagement. We had a bunch of soft commits. And then Donald Trump got elected into office and started the tariffs and throwing the global economy into a bit of a volatile state. So it was challenging raising money in that environment. We had to kind of pivot our approach and diversify from raising strictly with friends, family, accredited investors, and retail investors to pursuing more institutional level money. Because they suddenly, like the larger players, the family offices, the funds, they now saw the U.S. as more of a risk than a solid place for investment. And they viewed Canada actually as a great opportunity because we have very stable political system. We have a relatively stable real estate industry, and they see the supply-demand imbalance. So there's a lot more institutional money that's now looking to get into Canada. So we had to pivot to try and restructure to target that institutional level money.
Were you successful?
Yeah, we're currently in negotiations with a couple players to write a big check and basically close out the funding round. So it means that if you are one of these retail investors, you want to get in on this project before all the spots are taken, then you should give us a call and reserve your spot as soon as you can, because it's probably going to get snapped up very quickly soon.
Anytime we're talking about investments and talking about capital allocation, you want to talk about risks that are involved with any project. Can you talk us through some of your approval and your build and your manage risks that you have worked into your pro forma for this project?
That's right. Yeah. So we mitigate a lot of our risks by doing most of that upfront due diligence work ourselves. I went into detail about how that works. On this project in particular, we were able to stack the zoning bylaw amendment and the site plan approval process. So they're running concurrently, which it cut like a year off the project timeline. And we've been working very closely with planning staff along the way through a series of pre-consultation processes to work out the kinks in our application before we made it. So that means the final agreements are basically set. Like there might be a few minor changes here and there, but we're pretty much at that finish line right now. We have received incentives as well because we are introducing a 10% affordability into our project to meet CMHC requirements, but also the municipality said, you're doing some affordable here, have some more density. That's why we were able to go from 48 up to 52 units. On the build side, we work with builders that we've worked with before in the past, who we like, who we trust their level of quality. We understand how to work with them and how to manage these projects. And we do manage these projects using state-of-the-art quality management, using Procore. We've got our own internal project management software using ClickUp. And we have a series of checklists and QRQC, QAQC processes that we follow, all to make sure that we're tackling any challenges before they happen. And we're trying to mitigate those risks before they become an issue. Introducing a level of modularity as well. So this project, it's not going to be the fully modular system I mentioned, but rather a modularized prefab paneling system where the walls, floors, and roofs will be built in a shop and then shipped to site. So we are mitigating risks on labor shortages and timelines that way, making the project a lot more efficient in terms of construction. And then we work with highly vetted, well-trusted, and very competent professional property management firms to look after our projects.
Excellent. I appreciate you joining us today, Samuel. For our listeners, if you're interested in next steps, the next steps would be if you want to book a call with us at cal.westcliffam.com. You can, of course, listen to our podcast at www.westcliffam.com/listen. And of course, you can join our online community called WIN, Westcliff Investor Network, at win.westcliffam.com. And make sure you follow us on all major social media. We're all over on that. And of course, if you have questions, reach out 647-799-2264, info@westcliffam.com. And of course, you can text us for slides if you'd like to get a copy of these slides at 647-799-2264. Samuel, thanks so much for joining us today. And of course, we've got the legal disclaimer.
Fantastic. Thank you for having me. It was nice chatting. Appreciate it.
Appreciate it. Thank you very much, Sam.
Thank you.